Good day, traders, and welcome to the daily market, to the FOMC rundown. We, of course, have got a full session ahead with the preparation of the Federal Reserve meeting, which comes due tomorrow. Now, let's get stuck in. Of course, the meeting is tomorrow. We prepare for it today because that's what you do as a day trader. You prepare the outcomes so that when tomorrow comes, you're fully aware of the opportunity set. Now, in terms of how these sessions work, we very much go through a number of different things. We look at the expectations. Okay, we look at what the market's pricing in, what the market thinks. We then go back and review and look what's happened since the previous meeting, since that March meeting. What are the key things that we can take away from what Powell has said, what Williams has said, and what Jefferson has said? What can we learn, and ultimately, where is the nuance opportunities going to come from? We then, of course, look at some key data points. We focus on the previous statement as well as, what are those key opportunities? Okay, that's what you're here for. What is the opportunity scope tomorrow? What are the markets we should be paying attention to, and where can we actually make some money? All right, so let's get stuck straight in now. For those of you that are new to Tradelo, we do, of course, have the new website launching. That's what I showed you previously. That is the new website, which should be launching any day now. And of course, alongside that, we will be launching version 1 of the new application over the coming weeks. So very, very exciting. We finally are going to move into that web application environment, which will be fantastic. And then, of course, if you are new to the channel or you are first time with the FOMC today, keep in mind we do have a daily market rundown where we go through a number of different macro events, key charts, key opportunities, all those sorts of things. So just make sure you like and subscribe. And with that in mind, of course, don't forget to share these videos. It really does hype the channel. I know that you hear that a lot: share and like and subscribe and all those sorts of things. But the reality is, if the channel doesn't grow, there's no real incentive for us to keep doing what we're doing. So just make sure you like, subscribe, share, tweet, all those wonderful things. All right, let's get stuck straight into it. Now, the way we always start these sessions is we try and summarize it. We try and kind of find that topic summary. Think of it as like a headline, a newspaper headline of what it is that we think could be, the outcomes of tomorrow's meeting. Now, I think the key takeaway, the key opportunity now is this idea of our inflation expectations becoming unanchored. Okay, for the last couple of meetings, we of course have had all the Fed members, and in particular Powell, stressing this idea of they are watching inflation expectations very, very closely. And if you cast your mind back to March meeting, they specifically told us they're looking at the Michigan inflation expectations. They're looking at the New York inflation expectations. So they're telling us ultimately in real time what they are looking at. And that means we've got to be looking at it. And that's going to be the key look at today's session is, are these inflation expectations becoming unanchored or not? If they are, what is it that the Fed can do about it? And that's what we're going to deal with today. It's that what can they do if those inflation expectations are becoming unanchored? Now, what you've got in front of you is a chart of the 2-year. And this is a fantastic chart because all of you would look at this and say, well, we've got a wonderful pattern here called a flag, which is exactly what it is. We can see that since 2021, if you cast your minds back, the Fed began cutting in March 22, which is somewhere around there. Sorry, hiking. So we can see that the market was front running. Okay, the Fed beginning the hiking cycle. And then, of course, the Fed began with some 50 basis points, a couple of 75 basis point hikes, right? Because they were behind the curve on inflation. And ever since that day, of course, they stopped hiking rates, we can see the 2-year yields have settled in a range between 380 all the way up to, call it, 5.25%. Okay, and we stuck there. And this is the thing Donald Trump keeps saying is bring these things lower, bring these things lower. The reality is, can the Fed bring things lower at a time when inflation expectations are ramping? The short answer is absolutely not. Okay, and that's what we're going to deal with today. It's that question of, well, what can the Fed do? What are their priorities? And what is the opportunity scope around that? Now, keep in mind, very important, as of the March meeting, so that was not that long ago, as of the March meeting, pre-Donald Trump Liberation Day, the Fed told us that 2025, they expect 2 cuts. They told us 2026, 2 cuts. They told us 2027, 1 cut. Now, all of this has changed. We don't know what it's changed to. We don't know what the median dot is because we're not going to get dots at this meeting. But we are going to get dots, of course, at the following meeting. So this is one of those inter-meetings where the general thinking is that without those updated SEP forecasts, it's very unlikely they're going to want to do anything drastic unless, of course, they need to. Okay, and that's a general thing for all central banks. Okay, unless they have got updated forecasts, they tend to be a little bit reluctant to be overly dovish or hawkish without that updated data at hand. Okay, the key takeaway from all of this, however, is that we are going to be going into that next meeting with a very different set of economic forecasts in a sense of inflation is going to be raised much, much higher. Unemployment is going to be raised higher. Growth is going to be dropped lower. Interest rates and interest rate cut expectations, well, that's the big question mark. That's what everyone wants to know. That's the $1 million question, which is, Chairman Powell, you're telling us inflation this year is going to be above 3%. You're telling us unemployment is going to be above 5.5%. No, sorry, 4.5%. You're telling us that, of course, growth is going to be a lot lower than expected. Can you now tell us what's going to happen with interest rates? Are you going to cut or not? Now, this is what I'm leaning on in my tweet, where I said, I think tomorrow we're going to get the lean. I think Chairman Powell tomorrow is going to actually come out and he's going to give that guidance as to what ultimately the general thinking is going to be for that dot plot at the next meeting. In other words, I think they're going to reveal to us that there aren't any rate cuts coming this year. And that is the hawkish slant that I think is the key tradable opportunity tomorrow. And of course, if we get it, we know what to do. If we don't get it, we also know what to do. All right. Now, one of the key things to look at is, what have interest rates done? What has the actual interest rate curve done? Not just over the course of this last month, but what has it done coming into this year, and of course since Liberation Day. So what we can see is that going into October, if you cast your minds back, we started seeing a re-acceleration. Okay, the moment the Fed cut in September, which is September over here, we could see that all of a sudden we started to see the economic situation in the US accelerate, re-accelerate, and we saw those rate cuts. Doesn't matter which term you're looking at, all those rate cuts came out of the market. Okay, massive move out of the rate cut cycle. We then paused, okay? Pretty much for Jan, Feb, absolutely nothing was going on. Markets didn't move in terms of rates. All of a sudden, Feb, March, we started to see a little bit of a weakening in the economic data. Think ISM, think JOLTS, think all the key hard data points. And suddenly the market started pricing back in those rate cuts. Then Liberation Day came, which is this grey line, and the market went in a frenzy. It went and said, whoa, we need even more cuts because the economy is going to slow, the economy is going to deteriorate. Now, if we look at where we are relative to not just effectively the slowdown, from the start of the year, but also since Liberation Day, well, we can see that the June contract is pretty much a little bit lower than where it was, pre-Liberation Day. We can see, of course, the DEC contract is pretty much where it was. And it's only really when we get to next year, when we get into 2026, that we can see that we've not quite gotten back to those Liberation Day points. Okay, so what does that mean? Well, it's telling us exactly what the Fed's going to do. They're not going to cut anytime soon because they can't. But they might be in a position in next year to cut a little bit more. And that's the general thinking amongst the market, which is that there's no rate cuts coming anytime soon. They're not coming this meeting. They're probably not coming the next meeting when we get the updated SEPs, because like I said, there's going to be a lot of revisions to the data. And the only chance they're going to get to begin the process of cutting rates is late this year, or if we get a very, very sudden drop in economic activity. In other words, if we do go into a very, very big drop in some of the hardline data, then fine. All bets are off. They will, of course, cut. Right? And it's important you understand that framing, because it means that there's very little room for a dovish Fed tomorrow. There is quite a bit of room, of course, for a hawkish Fed, and we'll discuss why they may want to be hawkish tomorrow. Now, I think one of the key sort of questions that's going to get asked a lot tomorrow, you're going to hear this from pretty much every single reporter, which is tariff. You will hear the word tariff about 150 times in the Q&A at the press conference tomorrow. And the point is that I think everyone wants to understand is this very much only transitory? Okay, Chairman Powell, can you say with a high degree of confidence that it's going to be transitory and there won't be any second order effects on inflation like we saw during COVID? Okay, the Fed made a blunder during COVID. They absolutely dropped the ball. They were massively behind the curve, which is why they had to hike so aggressively, so quickly. All right, they don't want to repeat that. They genuinely are concerned about the situation currently. And so the question is going to be, is it transitory, Chairman Powell? Okay, now, yes, you are hearing from a lot of macroeconomic forecasters and the smartest people on the street about how, they should be cutting rates. And there is perhaps some justification in the hard data for that. Okay, the same as what Trump is saying. Trump is saying, look, we can see inflation dropping. Okay, we can see PCE came in at 2.6 this last month. We can see the average, of course, over the last 6 months is 2.8, and it is kind of generally moving in the right direction. The problem, of course, with all of this is that this doesn't factor in the tariff inflation. This doesn't factor in the expectations of what inflation is going to be like 1 year, 5 years from now. Okay, and that's the part the Fed's very concerned about. I expect when we get those ACPs next month, we are going to see the Fed raise this back up above 3%. They are going to raise the year-end forecast for inflation, core PCE, above 3%. And that's the thing they're scared about, which is if they turn dovish, if they cut at a time when we're about to see inflation start to move very, very aggressively higher, we can see it through the prices paid, what are the implications going to be ultimately for inflation moving forward. Okay, they cannot cut at a time when, of course, we are about to see inflation reaccelerate. Now, keep in mind, and this is important to stress, even before Liberation Day, even before tariffs, even before all this stuff kicked off, what did they do in terms of the revision at the March meeting? Well, that 2025 dot went from 2.6% for this year to 2.8. Okay, so they've actually already revised up their inflation forecast for this year pre-Trump tariff day. Okay, now that's important to stress because it means they were already worried about sticky inflation even before Liberation Day kicked off, which means guess what? That median dot is definitely going above 3% at the next SEP forecast, which is again why the Fed is in a bind. They cannot go up there and stand in front of the people of the world and say, look, we have got a priority with regards to inflation. It is our goal to ultimately bring inflation back to target, but we're going to cut rates today. Okay, it doesn't work like that. And I think that's the key takeaway, is that there is no room for cuts this year given what inflation is about to do in the US. Okay, and I think it's very, very important to stress that the only instance in which that all changes is, yes, if we got a very bad jobs report, if we suddenly saw unemployment tick up very aggressively, then fine, all bets are off. The Fed will, of course, bulk at the first bit of hard data that's weak. Okay, but until we get that weak data, there is no interest rate cut coming. Okay, now we're going to look at some key data points. Jolts, we can see it's moving in the right direction, right? Okay, in the down to the right direction. Okay, we can see a continued weakness there. But again, where are we? Well, we're pretty much back to where we were pre-COVID. Is the labor market weak? No. Jolt job openings are still very, very healthy. Okay, so fine, I get this whole idea that the whole economy is going to drop off a cliff, blah, 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 blah. But until you see it in the hard data, the economy is still very solid. And that's the word the Fed keeps using. It's a solid economy. It doesn't matter how you want to argue it. The hard data does not reflect the uncertainty and the concerns currently being shown in the markets. Okay, if we look at, of course, the unemployment rate. Okay, there we can see that the unemployment rate is stuck at that 4.2%. Now, sure, this is going to start to leak a little bit higher over the course of the next couple of months, but keep in mind, what did the Fed tell us? They told us they expect it to be averaging 4.4% this year. Okay, so again, they're expecting a little bit of a higher unemployment rate, so nothing there of concern for the Fed. And then finally, non-farms, we just had this last Friday, another solid print around 177. Again, right bang in line with that average that we've had over the course of the last 12 months. Okay, if you draw a line across there, for the last 2 years, the non-farm payrolls has been really, really, really good. Really solid. It is just a very solid labor market. There's absolutely nothing to worry about from a Fed's perspective. Okay, and this is important because I think sometimes we can read the newspaper and get a sense that, oh my God, it's falling off a cliff. The end of the world is coming. Okay, in reality, it isn't the end of the world that's coming. And ultimately, all we've got is a situation where we are just seeing, a little bit of softening in some of the data. Now, let's take a look at some of the other data points. So if we go across and turn across to the Michigan data, the key takeaway from the Michigan data is very, very simple. Okay, right now we can see from the Fred University of Michigan expectations, we can see inflation expectations are not stable. They're not anchored. They are moving very aggressively up and to the right. Okay, and this is the exact report that the Fed has told us to look at. This is the thing they've said keep an eye on. And I just want to stress, if you go to look back at 21 into the first point where the Fed began hiking very aggressively, what did inflation expectations do? Okay, they ramped above those 5%. We are now back at 5%, and the Fed is sat idle. The Fed is sat with a situation where the market thinks we're going to get 2 cuts this year, 2 and a bit cuts this year. Okay, this is not something the Fed is going to tolerate forever. Okay, this is one survey, of course, it's one of the soft surveys, but at some point they're going to have to do something about this, because if they don't, this keeps rising. Okay, now very important, this little orange line here is the point at which ultimately the Fed began the process of very, very quickly hiking interest rates. Think 75 basis points, 75 basis points. Now, these break-evens topped out at 5.5%. Okay, we're at 5%. This has got to be alarming the Fed. There's absolutely no way that they're going to do nothing about this. This will be done. Something will be done about it at some point, because these inflation expectations are not going to drop off. Now, that's one soft survey. There are, of course, other surveys that the Fed pays attention to. And one of those surveys is the New York inflation expectation. Okay, same sort of thing, different demographic, of course, different voter base and all that sort of thing. So yes, these soft surveys can be influenced, of course, by the voters that or the people they're asking. Now, this is the New York one, and you can see it's slightly different. the picture is not as panicky as I'm making it out to be. They do, of course, show the 5-year median expectation. They show the 3-year median expectation. And we can see, if you look at the 5-year in particular, we can see how that moved higher. It then sort of settled down, but ever since, it's almost back to those elevated levels. Okay, so it's a little bit less volatile, but I think the key takeaway 1 year is those 1-year inflation expectations ahead. Okay, we can see they are now at the highest levels since the middle of 2023. In other words, we have got a de-anchoring taking place in inflation expectations according to the surveys. Are surveys wrong? Yes, of course they could be. But it doesn't mean the Fed's going to ignore them. The Fed's going to have to do something. Now, that something does not mean they're going to hike interest rates tomorrow. Okay, they are not going to hike interest rates. They are not even going to dare entertain the idea of a hike in interest rates, because that's not how sequencing works. What's sequencing? Well, sequencing is if you want to tighten conditions, you don't come out and say we're hiking. What you do is you come out and you say, we are showing some concern about inflation expectations. Okay, and the market will take it as hawkish. Then at the next meeting, you say, we are concerned about the inflation expectations, and if they do not move in direction we want them to, then we may be forced to intervene. Okay, that's step 2. And then step 3 is, because inflation expectations continue to rise, we've now decided at this meeting to hike interest rates 25 basis points. Okay, 3 different steps. Right? That is the sequencing the Fed takes. They will not come out overly hawkish, because if they do, they'll scare the living shit out of the markets. Okay, the point is that they need to get out ahead of this. I think that's the key takeaway. It's the key thing I think is a really good opportunity for tomorrow. And I think there's actually a high probability for it. You're not seeing much talk about it, but I think it is one of those things where I think Fed Chairman Powell will come out and he's going to talk in such a way that he's going to push back on this idea that rate cuts are going to be possible this year. Okay, I think that is the key play tomorrow. He's going to push this idea out that we're not going to have enough certainty, we're not going to have inflation where we want it to be to warrant rate cuts this year. And that is step 1 in terms of the sequencing, which is push out those rate cuts for this year and just lean against this idea that the Fed is going to cut, perhaps at the July meeting, because that's what the market's thinking, July/September, and the market's also thinking 2 cuts. Okay, so they need to get rid of that policy, that little bit of loosening, so that they can just tighten up some of those inflation expectations. Okay, now that's the survey inflation expectations. We've of course got market-based inflation expectations, and we've got swaps. Okay, there's a number of different ways you can view inflation expectations, but the market-based inflation expectations are also starting to tick up. Okay, we can see they're now back above the 50-day average, which is around that 237. They're around that 240 level. They're not de-anchored. They're not even close to the high of the year, but they're moving up and to the right. Okay, keep in mind those 5-year in market inflation expectations got to a high of 280. We're only at 240. Okay, the point is that we are starting to see all the inflation expectation survey measures now start to point towards higher inflation expectations. Okay, and the Fed's going to have to do something. They might not do something now. They might not do something in the next meeting, but the reality is this is not going to stop. Okay, inflation is one of those things, or particularly inflation expectations, once they become embedded in people's psyche, we tend to see them move and continue to move until we get some pushback from Chairman Powell. Now, let's have a look at what Fed Powell told us recently, because we do want to understand what is his stance. What has he said lately? Now, what we would normally do for this, by the way, is we would not be looking statement to statement, speech to speech from each individual member. We'd actually be looking at the previous statement, because central banks used to just give us an update every 6 weeks, okay? And that's what we would look at. But the reality is that we get so many different speeches from the key central bank members nowadays that the previous statement is dead. Okay, it's kind of pointless looking back at the March meeting, because so much has happened since then, and more importantly, Powell has said so much since that point. Now, keep in mind, the last time Powell spoke was 16th of April. Now, Liberation Day was 3rd of April. Backtrack Day was, I think, 12th of April. So effectively, this speech was given after Trump backtracked, after Trump gave the 90-day extension. Okay, so it's important to contextualize an understanding. It was after we got a little bit more of a positive spin with this 90-day extension. Now, Powell told us a number of things. Number 1, he said, administration's policies are still evolving and effects remain highly uncertain. Okay, it goes without saying. That hasn't changed. It remains highly uncertain. He told us they're at or near maximum employment. He told us they may find themselves in a very challenging scenario in which the dual mandate goals are in tension. Okay, and this is important to understand, because what he's leading on here is this idea of we may be forced to choose ultimately the bogey. Which bogey are we willing to accept? Okay, are we willing to, sort of focus on inflation as the priority and accept low growth or perhaps a recession, or ultimately, are we going to focus on the economy and accept higher inflation? Okay, at some point, they're going to reveal that. Now, we know as of last year, if you go back to last year, they told us twice. Okay, they told us in March of last year that inflation wasn't the priority. And then if we go to September, if you remember September, they cut 50 basis points the moment we got one bad labor report. They cut 50 basis points. Okay, so they've showed us twice in the last year that the priority was never inflation, and it's always been the economy. That hasn't changed. Okay, yes, Powell has come out in recent times talking tough and how we're going to focus on inflation, and we must focus on inflation. But in reality, until they actually do something that really pushes back against inflation, you have to assume they're always going to focus and prioritize the economy, okay, and growth. Now, why does that matter? Because at some point, yes, he'll come out tomorrow, he'll talk tough on inflation like he always does, and he'll show some concern for growth. But the reality is, the moment we get that first big non-farms where we get them as perhaps a sub 100 number, even a negative print, you can bet your bottom dollar the Fed's going to cut 50 basis points very, very soon thereafter. Okay, that is ultimately the way the Fed reacts, is they do focus and prioritize the economy, and there's a simple reason for that. Okay, the general theory of economics suggests that if you are going to go into a recession, you don't have to worry about inflation because it'll take care of itself. In other words, the demand destruction that comes from the recession will bring that inflation back down to target. Okay, and so that's why they typically will focus on the economy over inflation. However, again, it's something to listen out for. All right, it is something to listen out for. But like I said, actions will speak louder than words in this instance. Now, there he goes and says, our obligation is to keep longer-term inflation anchored. So that's that very important line of, well, we need to keep it anchored. Well, Chairman Powell, they're not anchored. What are you going to do about it? Inflation effects of tariffs could be more persistent depending ultimately on inflation expectations. Now, this is one of those things to listen out for very carefully in the Q&A tomorrow, which is, Chairman Powell, can you tell us, do you think ultimately that this is going to become embedded for a longer period of time? In other words, if he starts to lean on this idea that inflation is becoming embedded and ultimately we could have higher inflation for longer, that is going to be taken as very, very hawkish, because remember, their mandate is to get inflation back to 2% in the medium term, and they're expecting inflation to come back to target next year. Okay, as per the previous dot plot projection, they're expecting inflation to be back at target next year. If it's no longer next year, if they're still going to be at 2.5%, 3% next year, they're going to have to do something about it. Okay. Otherwise, right? It's not to say they will do something about it. If they don't do something about it, we're going to continue to see the sell-off in the long-end bonds. We're going to continue to see investors say, "Screw this idea. I'm not holding U.S. assets," when ultimately they're allowing inflation to run hot. Okay, and again, we'll talk a little bit about that because we saw that play when the Fed cut 50 last year and when they showed us that inflation isn't their primary goal. Okay, we did see investors balk at the idea. They did sell off the long end, and we did start to see the steepening in the US curve. Okay, now, very, very important, this idea of waiting for greater clarity. That will be there tomorrow again. They've got time. They want to wait for greater clarity before they make any decisions. And I think the other two things that were quite important was this two comments at the bottom here, where the Fed has to keep inflation expectations well anchored because it's their job to ensure it doesn't become ongoing inflation. So again, I think that is the key highlight for tomorrow, which is it becoming ongoing inflation, Chairman Powell? Because the soft surveys continue to point toward it is. So what are you going to do about it? And like I said, first step one in the sequence is push back on this idea of rate cuts this year. That will be the step one, and that will be taken as quite hawkish. Of course, given where the equities are, they will stage a little bit of a fright. And actually, I think gold will actually get hit nice and hard on that as well. But we'll talk about that a little bit later on. And then, of course, the other one to pay attention to is this idea of tariffs are larger even than in the Fed's upside estimates. And this is key because this was given to us post-Liberation Day. And what Powell's telling us is that their initial idea of where tariffs would settle was X. And now, given what they know as news, it's going to be a lot higher than what they expected. In other words, they're starting to prep us for a PCE dot that's going to be in excess of 3% for this year. Okay. Now, again, this year isn't necessarily a problem. Why? Because the Fed doesn't set policy for this year. They set policy for the medium term. So what's going to be important is the 2.2% inflation for next year. How high does that get revised? Okay, because if it gets revised above 2.6%, that's pretty much where we were this year, which means the Fed's not going to be able to cut this year or next year. And that's going to be a fun one. But again, like I said, we're not going to get that until, of course, the next meeting. Now, Williams, you can go through this, take a picture. I'm not going to go through it in great detail, but Williams has told us pretty much the same thing, which is policy is well positioned. There's no need to do anything anytime soon. Tariffs will drive up inflation this year and lower growth, and inflation expectations are important to watch right now. Again, leaning on this idea of we need to be watching inflation expectations. All right. Now, our Fed whisperer, Nick Timmerus at the Wall Street Journal, he summarizes these things very, very well, which is why we pay attention to him. And he's come out, and there's a couple of key sort of phrases I want to take out from previous Fed members, just to make you aware. Okay, you don't have to go read the whole article, but the key points are here ultimately, which is that the Fed is in a very tough spot, and of course they're not going to cut anytime soon because they have to keep this sort of focus on inflation. But there is this concern, there's this big split within the Fed about what is actually going to happen to inflation. Okay, some officials are talking about inflation becoming unanchored. Some officials are talking about, we shouldn't worry too much about inflation because it's transitory and we need to get on with cutting. Okay, so there is a big divide on the board, and of course we're going to start to understand that divide when we get that dot plot at the next meeting. That said, there was a couple of key takeaways, and I think if you just go and read this, it says, it will no doubt be a very difficult judgment for Chairman Powell. Okay, that is the key thing right now, is this dilemma of what do they choose? Do they choose the economy or do they choose inflation? Now, there's a couple of quotes from Richard Clarida first, and he said this is not going to be a cycle where the Fed preemptively cuts because there's a forecast of a slowdown. Okay, they're going to actually need to see it in the tangible data, in particular the labor market. And there it is. Richard Clarida is telling us they will keep rates unchanged so long as the data doesn't weaken. If the way data weakens, like I said, they'll go 50 basis points. Why? Because Powell still thinks they're restrictive. Okay, he still thinks they're roughly around 125 basis points to neutral, which means if suddenly we see a 50,000 non-farm payrolls, they're going to cut 25 or 50 immediately. They're not going to hang around. Okay. We also then had Lael Brainard, who was the deputy governor of the Fed. And she said over 7 years, the Powell Fed has a track record of waiting to be very sure about the data and then going very fast. And this is the idea of if it suddenly deteriorates, we'll cut 50. Otherwise, what we're going to do now is wait. Wait for clarity. Wait. Focus on inflation. Not do anything anytime soon. Okay. More importantly, even if I were thinking I want to look for a way to cut, I would talk hawkish because I want to keep these inflation expectations anchored. This is from Robert Kaplan, another Fed president, of course, one of the key Fed presidents of the Dallas Fed. Now, the takeaway there is, again, this idea of if you wanted to ultimately get inflation expectations back in line, you're going to have to start thinking about a more hawkish approach to how you talk to the market. Okay, so there's a lean there. There's a couple of ideas to take away from there. And then finally, this idea of will the demand destruction ultimately help offset the impact of cost increases? The truth is, Kaplan says, no one knows. Okay, and that's the danger with all of this. In fact, if you think about it, one of the worst scenarios we could find the US economy is a situation where the economy slows, perhaps down, below 1%. So we still have some growth, but ultimately inflation gets above 3 to 4%. That is probably the worst situation the Fed can find themselves in, because what do they do at that point? Do you kill the economy into a recession by keeping rates higher or by perhaps hiking rates? You need to hike. You can't have inflation 3 to 4% and not hike interest rates. Okay, and that's the danger right now, is that no one actually knows whether or not these tariffs are going to prove to be inflationary or not, or whether or not there will be demand destruction. Now, in terms of the statement, a couple of things to watch out for in terms of the actual economy. Okay, the first part of the statement is where they talk about the labor market and, of course, the economy. We are going to see this change. The economic activity is not expanding at a solid pace anymore. We did, of course, have that very bad Q1 print. So this will be adjusted. It's not necessarily new news. It's expected to be adjusted. The key one, of course, is to pay attention to this. Inflation remains somewhat elevated. Okay, again, there's no real expectation this gets adjusted. It's very much expected to be repeated. But again, if this gets changed in any shape or form, inflation is starting to accelerate or inflation is elevating, whatever it might be, if they change this in any shape or form, it's going to be to the hawkish side, and the market's going to jump on that. They're going to jump on this idea that risks to the inflation outlook are now starting to tilt to the upside. Okay. In terms of the balance of risks, there's nothing really that's going to be changed there. Of course, there's no expectation on the balance sheet. And then in terms of the guidance, we could perhaps get an updated guidance. But like I said, right now, both Williams and Powell have told us policy's in a good place, and they ultimately just want to sit on their hands and do nothing. Okay, now we'll talk a little bit about some of the Q&A and where some of the questions will be around the Q&A. But let's get into some of the key charts, because right now what we can see on the Fed cut expectations, and this is kind of the key to start to understand where is the opportunity tomorrow, where is the market you want to trade. But if we look at what the rate cut expectations have done through to the end of 2026, we can see since the start of this year, we started to get this little bit of a weakening. Okay, we started to see the data weaken, and then of course we got the tip of the iceberg where we got Liberation Day. Okay, that has since reversed, and we're now pretty much back to where we were pre-Liberation Day. But the point is that the economy started weakening already into the tariff situation. Okay, we started to see a little bit of a growth slowdown already into the tariff situation. And so I think the key thing here is that the market is still pricing in, roughly speaking, call it 100 basis points, maybe a little bit more. Roughly speaking, pricing in 4 rate cuts between now and the end of next year. Okay, now like I said, if the Fed is going to revise up their inflation expectations for this year, there's no way they can cut this year. Right, so what that means is the market's expectations of 4 cuts between now and next year correct? Perhaps so, because a lot can happen between now and then. But the point is they're going to have to push out those hikes for this year, because we're not going to, those cuts for this year, because we're not going to get those cuts at a time when inflation is elevated unless the economy slows down. Okay, and that's why I'm leaning on this idea that is where the opportunity is, because the market is pretty much pricing in what the Fed's pricing in, which is 4 cuts between this year and next year. The market is just ultimately pricing it in. Starting in September, perhaps 2 cuts September, December, and then of course 2 more cuts next year. Okay, now this is one of the key charts to pay very close attention to. Like I said to you earlier, the bond markets is always very, very clean in terms of a verdict. And one of the things I'm starting to sort of think a great deal about is this idea that until such a time that the Fed gets inflation back under control, we are of course going to see this curve continue to steepen. Okay, now I'm not going to go through what a steepen and a flatten is, but what I do want to point out is that in every recession, it always comes from an inversion where we go negative 210 spread to a positive yield curve. Now, very, very important, if you go look back at the last couple of recessions, every time we do steepen, it's the speed of the steepening that ultimately breaks the economy. Why? Okay, and I explain this every single time. How you have to think about it is right now, the market's trying to price in rate cuts. Okay, at the same time with the market pricing in rate cuts, investors are saying, well, hang on a sec. You're pricing in rate cuts at a time when inflation is not at 2%, which means ultimately inflation is higher than expected, and we want a higher term premium. Therefore, long end rates need to be about 5% or 5.5% or 6%. Okay. And this is why we're in that flag formation. You go look at a 10-year chart, which we will do in a moment. That's why we're in this flag formation, because investors are saying, I want higher yields. Otherwise, I'm not going to own your bonds. Okay, now the problem is, like I said, don't forget, the Fed is coming into complete opposite territory to what ultimately Donald Trump wants. Trump wants lower yields. Why? Because they have a debt problem. And so this is the problem, the conundrum that the market faces right now, which is the curve is going to keep steepening because inflation is not being brought back under control. And if you're not going to bring inflation back under control, investors aren't going to want to buy your bonds. All right, and this is the problem we have, is that even though we're heading into an economic slowdown, yields continue to rise in the back end as well as the curve continues to steepen. And why is the curve steepening? Because the market's pricing in rate cuts. And again, if we go look, and this is the key, go look at what the curve did at this point here when the Fed cut 50 basis points in September last year. They cut 50 and the curve went from 0 all the way to 40 basis points. Why? Because the curve said if you're going to cut before you get inflation back to target, well, we want a higher yield. Okay, we want higher long end yields because you are ultimately running a hot economy. Okay, of course we had the Trump landslide. And we know Trump wanted a fast economy. He wanted rapid growth. He wanted deregulation. He wanted interest or a cut in taxes and spend. Okay. The result was we saw the curve steepen. So we're continuing to see this curve steepen every single time we get this idea of a hot economy or higher inflation and a Fed that is not willing to push back against it. Okay. Now this is important because this curve is not going to stop steepening. It will only stop steepening at a time when the Fed actually does reprioritize inflation. Okay, does it do it tomorrow? This is one of the key plays. Okay, if the Fed was to turn hawkish tomorrow and they were to tell us no cuts this year, yeah, you're going to see this curve flatten quite nicely. Right, we should get back to those Liberation Day levels. And ultimately, this is the irony of it all. If you want to get yields lower, Chairman Powell or Mr. Donald Trump, you've got to get inflation back down first. How do you get inflation back down? Well, you're going to have to take a little bit of short-term pain. You're going to have to get a little bit more hawkish, ultimately, on spending in the United States. That is just the reality for the U.S. economy. Okay, now, in terms of going into tomorrow, I think one key chart to pay attention to is the VIX. this is the highest VIX. Okay, these little vertical lines are all the meetings, the Fed meetings. What you can see is this is the highest VIX scenario context into a Fed meeting. Okay, yes, it's squashed quite a lot, but we are going with a 20-day average around 27 on the VIX. Okay, I mean the highest for last year was somewhere around 19. Right, so this is a context in which the Fed could say very little and the market could overreact. That's the key takeaway. That's why we look at it. So like I said, should the Fed come out and say, hey, inflation expectations are starting to de-anchor and we don't think cuts will be possible this year, barring, of course, a significant slowdown, yeah, you're probably going to see some outside moves in a couple of markets, just given the context of where the VIX is and where the level of uncertainty is right now in the market. Okay. In terms of the dollar index, this is a key one to watch. We talk a lot about this chart on the daily market rundown. But the key takeaway here is what we can see is every other market has pretty much retraced Liberation Day, barring one, which is the currencies. Okay, the dollar has not retraced. It's still about 4% lower from Liberation Day, and that tells you everything. Okay, there is an exodus out of United States assets, whether it's bonds, whether it's equities, doesn't matter. There is a bit of an exodus now out of US into other economies. It's why the DAX is up 27% in 18 sessions. Okay, it's up because we're seeing money flow out of the US into DAX. We're seeing money flow out of the US into Asia. We're seeing Taiwan, of course. We're seeing a lot of money being taken back onshore into foreign countries. Okay, so what that does mean is ultimately we need to keep an eye on this dollar, because a weak dollar, at least at this pace, the speed at which this dollar is depreciating, that does have implications, of course, for inflation. Okay, strong dollar, you are going to import deflation. Weak dollar, you're going to import inflation. Okay, and that's the important part here. We have seen the US dollar, for example, is down 11% against the euro. Which means if you're buying that wonderful BMW in the United States, it's costing you a great deal more, because ultimately you have to pay a lot more for it. And that's the key takeaway, is that this weak dollar is also going to start to add to inflation expectations in the US, which is why we keep an eye on it. Now, why am I showing you this chart? Well, because the play isn't necessarily for a continued weak dollar tomorrow. The play is more if we see a prioritization of inflation. Okay, should we see a little bit of a hawkish pushback from the Fed? Should we see them come out and say, look, rate cuts are probably not going to happen this year? Yeah, there's going to be a great deal of movement. Yeah, you are going to see the euro, the pound, pick your currency. You're going to see a number of currencies come very aggressively under pressure against the dollar. Okay, it is a very much overcrowded trade. It's a very sort of everyone is very, very net short the dollar. So keep a close eye on that into the session tomorrow. Now, this is just the trade-weighted dollar. A different way to look at it, of course, the dollar index itself is very heavily skewed towards the euro. But this is what it looks like. And we'd all look at that and say, hang on a sec, I can see why Donald Trump's a little bit pissed off, because if you go back to 2008, great financial crisis, we were trading on a trade-weighted basis around 95, and we're currently, as of today, sitting around 125. Okay, which suggests that the dollar is somewhere around 30% higher against its major trading partners over the course of the last 10, 15 years. Okay, that is problematic, because everything, it's great for the US, but it does mean that the US runs a significant fiscal deficit, a trade deficit. Okay, then in mind, of course, this is an interesting chart to keep an eye on, because at some point we are going to take out these levels. We take those out. We did speak about this in the daily market rundown. We are going to see a significant amount of volatility spread into a few markets, as we do, of course, see those flows being moved out of the US and into a number of different countries. Okay, now in terms of gold, this is a market to pay very close attention to for a number of reasons. One, I think we had a technical top. Okay, I think we have found a top for now for the next couple of weeks and months. And very interesting, we are up a good $150 in the last two sessions as China has come back off of its holiday and started its typical overnight buying spree. The reason I'm showing this chart is because, like I said, this is the market that's very, very sensitive to both the dollar and inflation expectations. Okay, now, should the Fed come out tomorrow? Should they be hawkish? Okay, should they lean on this idea of no cuts this year? The gold market will come under some significant sell pressure. Why? Well, because one, we should see that dollar rebound. We should see a little bit of a relief rally in the dollar. And at the same time, we should see inflation expectations start to pare back. And ultimately, the combination of those two, lower inflation expectations as well as a higher dollar, will put quite a significant offer back into that dollar. Okay. The important part to point out is that I'm not saying gold's going to collapse to $3,000 tomorrow. I'm going to tell you that we're going to sit inside this range for some time yet. Why? Because the technicals are pointing to a very overbought market that has now found a short-term top. Okay, so just keep a close eye on that, because I think gold could be a very tradable market in a hawkish scenario tomorrow. And then finally, the S&P 500 finds itself almost back at key levels. We are approaching that 5770 up to 5900. This is the area of interest. Okay, this is where everyone's interested. I think, you know, everyone in the dentist is looking at this area, and I'm not going to tell you why. You can just see it on the chart. Okay, it's been previous record highs, it's been previous congestion areas, it's been previous accumulation zones, it's been previous support and resistance, it's been previous everything. 5770 to 5900 is the area everyone is watching. What I do want to point out on the chart is we can see over the last 5 sessions a great deal of uncertainty. Okay, there's not much going on. If you look at the last almost 8 sessions, we're about up 80 handles only, which I know it doesn't sound, or it sounds like a lot, but it's only 1.5% with a VIX at 24. Okay, the point is we can take that out in a matter of an hour or two should the volatility kick back up. Okay, the point is right now the market is pretty long. The market has had its relief rally. The market is approaching a key area where you are going to see some very interested sellers. So again, what does the equity market do in a more hawkish environment? Well, sure, we are going to back off pretty quickly. The market will stage a little bit of a fright, first back down towards that 54.50, perhaps fill that gap at 5300. And like I said, given where the VIX is, it should fill it up pretty quickly. Okay, this is one of those trades that you hold for a day or 2 or 3, and you should get your 2, 3, 4, 5% move pretty fast in the S&P 500. Okay. We'll talk a little bit more about some of the fundamentals for the S&P tomorrow, but the key takeaway is I think it's a good market to trade simply because of where that VIX is relative to ultimately where it's been the last 20 days. Okay, a VIX at 28 on the 20-day average suggests that a hawkish Fed, and you will get a pretty decent outcome. Okay. Now, let's summarize in terms of what to expect. Like I said, the statement, we're expected to see an adjustment to the growth. 100% they should adjust that. In terms of inflation, watch out for that. There could be a little hawkish surprise there. Could not be. Okay, if there's no hawkish surprise, there's nothing to do. If there's a hawkish surprise, there's something to do. That's the key takeaway. In terms of the Q&A, some questions to watch out for. Like I said, the word tariff is going to get used 150 times tomorrow. So what are the impacts of tariffs and the uncertainty on inflation in the economy? And again, they're going to try and tease it out of him. What they're ultimately going to try and get out of him is, hey, are you focusing on inflation? Are you focusing on the economy? Can we expect rate cuts anytime soon? Blah, blah, blah. So listen carefully. Okay, particularly that sort of a question. Can we expect rate cuts anytime soon? Watch how he answers it, because he'll try and steer off of that to say, look, right now we're not thinking about rate cuts because there's a lot of uncertainty, and it might not be possible to think about rate cuts until we get greater clarity when all the deals have been discussed moving into next year. It'll be something so ambiguous like that, but the market will latch onto it because he'll be then pushing against this idea that rate cuts are coming anytime soon. All right. In terms of then some of the questions around the inflation dot, perhaps he gets asked about that. I think you'll get a couple of reporters talking about that dot. What do you expect the median projection to be? Of course, he's going to answer that, hey, everyone writes down their own dot. I don't control anyone else, and we'll see about that next month. So he's probably going to push back on that idea. But again, the journalists are probably going to want to know what ultimately is going to happen to that dot, and is there a cut still possible for this year? And then, of course, how concerned are you about the sudden growth slowdown? Listen to how he answers that. Okay, it was quite a significant slowdown. If he shrugs it off and kind of says, no, not concerned about it at all, it's we need to focus on the inflation side. Yeah, perhaps the market takes that as okay, hang on a sec, he's actually not that worried about growth, and rather he is focused on inflation. Okay, but like I said, actions speak louder than words. Okay, so that's the summary for tomorrow. Now, of course, for the Tradelo members, just post your questions in the Discord channel. It is there, the central bank channel. So post the questions there. Like I said, of course, always manage that risk within the application. And then I will be posting some live posts in the Discord channel during or after the Q&A and after the actual statement. Just let me trade through the markets, and then I will, of course, give you some updates. So just pay attention to some of those updates, of course. Yeah. Okay. We're going to open up the floor now for some questions. So if there are any other questions, please let me know. Let's get a couple of questions across. We've got another 5 minutes because we do need to shift across. We've got a 10-year auction out of the US coming up. So a couple of questions, we can take those, and then we can go from there. So I don't know how many people we've got on. I'm gonna put some hearts there. I don't even know how to do this. So if you have got some questions, just bring them in. Otherwise, we can perhaps go and consider. Yeah. Okay, I got a question coming in about, what market is the key one to sort of focus on as a proxy. Well, again, I think the key market to focus on if they're going to be hawkish will be the 2-year for sure. Watch that market very closely. If he's going to say something hawkish, you are going to see quite an aggressive sell-off within the 2-year. So that will be your proxy. If 2-year sells off 15 to 20 basis points tomorrow, that is the hawkish lean. And of course, like I said, there'll be implications for the dollar in particular. As a result, gold will also stage a bit of a hard offer, and as well, of course, the equities will stage a little bit of fright to the downside. So keep an eye on that proxy market, because that should ultimately lead the way for you. Okay, are there any other questions coming up? Let's see if we've got any other questions. Okay, let's leave it at that. We obviously don't have too many people joining us live. That's fine. If there are any other questions, do post them in the Discord channel. Otherwise, thank you for joining me for this month's FOMC rundown. Good luck tomorrow. Of course, manage at risk. Go make some money.